Good, good. We're good. Hi, everybody.
Wait, it's saying setting up your meeting for Facebook.
I can see that we're live.
Okay, perfect. Well, here we go.
Awesome.
One of these days we'll get this whole technology thing down. The funny thing is you'd never know that my husband and I actually own a tech company. So there's that.
And you are super technical.
Yeah, I don't know.
Yeah, I think you are much more so than me.
But. Yeah, well, we'll see. Well, how's your day going so far?
It's good. It's good. I was just telling you earlier, we had to run out for a lockbox issue, such major issues that we have to deal with in this world.
I heard, by the way, I don't know, who's your cell phone carrier?
Verizon.
Because I heard agents here were saying that the new iPhone, if you're on AT&T, the updates are not compatible on your phone to get into Supra. So you have to get to a different tower, I guess, to update. And I don't know, something messed up. I'm like, well, I'm still on the 7 or 8, so I'm not worried about it.
We don't use Supra in our market. We used to. We use Century
okay.
now.
Oh, well, there you go.
Yes, one more level of complication. So, hey, you guys, Karen Schaefer and Heather Tankersley here. Thank you so much for joining us today. We're glad to see you.
Yeah, and we have finally come up with sort of a name for our weekly investor segment. So we're going to be calling these our Way to Wealth Wednesdays. And we're going to be largely focusing on real estate investing, things of that nature, because it's really where we both have the most experience and where we built our wealth. But down the line, we may look at things like stocks or options or other types of investment opportunities, because it's markets are cyclical and things change and so on. So welcome. And as Karen reminded me, we probably need to just give our little legal disclaimer that we're not attorneys, we're not accountants. This information is educational, and certainly we encourage you to seek professional guidance from those who are licensed to practice law and CPA stuff and all that good stuff. So that being said, again, I'm Heather Tankersley. I'm here in Austin, Texas. I do real estate in Austin, Texas primarily, but then we also still flip houses and have rental properties and land and so forth in South Florida. So kind of Central Texas and South Florida, investments, traditional real estate, all that good stuff. And Karen?
Yes, Karen Schaefer, and I'm also a real estate agent and investor here in Southern Colorado, so can help you with anything throughout Colorado, whether it's investment properties, buying, selling, etc. And one of my favorite things to do is work with real estate investors, and that's kind of what where Heather and I started too. So we're more than happy to help you guys. And also, one thing Heather and I wanted to tell you from here on out is if you have a deal, a transaction, a purchase, a sale, a commercial building or a multi or a single family, whatever it is, and you want to do a quick deal analysis with us, we're happy to do that. Just jump on and say, hey guys, I have a quick deal analysis I want to run past you, because that's like, it's like somebody just said, hey, I have a free martini for you. Like, we just get so excited because we're both such nerds to do a deal analysis. So we'd love to do that for you. So if anybody has one, doesn't matter where you are, anywhere in the country, just let us know and we'll help you with that deal analysis.
Perfect. I love that. So today we're not going to be too long. We got a little bit of a late start. I had a call that ran over, and Karen had, different technology challenges, issues. Lockbox issues, and I just had straight out tech issues. So anyway, we want to talk a little bit today about stepped up basis, and we're not by any means getting political. Just part of being an investor and really being an entrepreneur is saying, okay, we're cool, like, talking about the election, we get it, whatever happens, but let's just get the rules now. So we've had one set of rules for the last 4 years. We had a different set of rules for the 8 years before that. And moving forward, we're probably going to have a different set of rules, if not now, then in 4 years from now. So the real successful people that get wealthy are the ones that say, okay, I'm not going to get upset about this. I'm not going to, whatever. I'm going to see what I have to play with and play within those rules. And so today we want to kind of talk about whether it comes to fruition or not, but just sort of planning ahead and looking forward, I guess, is the topic of the day. But in particular, we wanted to talk about the stepped up basis, which kind of you may or may not have heard much about it. I don't admittedly know what the proposal is for the estate tax. I believe that under Trump, it's $5 million. And I don't know, I think it was 2 million prior. Again, this is where your CPA comes into play here. And you can do things, and your tax planner will advise you in terms of, you know, is it time to set up trusts? Are you in a state that you can just do a will? And so it's a moving target. So, but that being said, it may or may not apply to you depending on where you are with that. But one of the things we wanted to talk about that has, you know, is one of the plans under a Biden administration is what he plans to do with regard to stepped up basis, and then how this affects you, how it opens up some opportunities as an investor, and kind of what this could look like. So you want to kind of, you kind of pulled some good information to make it easy to understand, Karen, if you want to.
I did. Yeah, because Heather was talking to me about this the other day, you guys, and I told her, I said, you know, I'm a little familiar with it, but I'm not a lot familiar with it yet. And so I went in to do a little bit more research, and I have to backtrack here for a second, and I'll come back to this article. But I was telling Pete, my husband and I were talking about that this morning, and we said, you know, one of the biggest mistakes we think people make before an election is not looking into things, even just having like a skimmed view of things. You know, like for this one, I had more of a skimmed view versus an in-depth view. And we said, it's amazing to me how many people don't look at how you're going to be affected or how the country's going to be affected by your choices. And they really just choose things based on a personality or an affiliation or emotion. And it's kind of interesting. And again, we're not trying to make this political, but just do your due diligence, guys. Make sure you're understanding, you know, how is this going to affect you? How's it going to affect your family? How's it going to affect your country? These are important things. And so if you didn't do that in advance, I'm going to really recommend that you check into this information today that Heather and I are going to talk about. But I found a great article on the taxfoundation.org site, and it's really talks, and Heather, let's, you know, this is kind of like a state tax in a way, right? Because that's an easy way to say it. But it's sort of interesting. So there's tax, basically it's a tax on death. So that's one way to think about it, a tax on death, right? Up to 67%, which is frightening. So if you're a millionaire, which many people are today because our assets have grown exponentially over the last several years, you could be taxed up to 67% on death, or your heirs could be taxed, which is really kind of interesting. It's
mind you, and let me just point out, you've probably paid tax on a lot of that over your life. Right. This is just like your net. Yeah. This is what you're left with after tax wise. So just to clarify, and this isn't a Democrat or Republican thing. It exists under either administration, just so we're clear here.
Absolutely. And Myron Golden, I don't know if you've ever heard him speak, Heather, but he's an amazing speaker. But he talks a lot about taxes, and he said one time, he goes, what's the most expensive thing you have to pay for? And people always say, you know, my mortgage or my kids' education. He goes, no, it's tax, because you get taxed, and then you get taxed on the income, then you get taxed when you use the money, and then when you invest it, you get taxed. When you die, you get taxed. Tax is and that's why people should be very, very familiar with taxes. And I even said, you know, I had a general familiarity with this one, but not a full familiarity. And now it's very interesting. And then the other thing that I will tell you too, before I jump into this, is when Pete and I were talking about it this morning, he's reading a book right now on IRS tax code.
That's lovely light reading.
I know, and he loves it. It's very funny. It's like his third book. But he was saying that one of the authors said, you know, if you really look at the IRS, 90% of the IRS code is how to save tax. And it's kind of interesting. It goes, you know, a lot of it is a mind game, because they're telling you how you save tax. And one of the biggest ways, you guys, is by investing in real estate. And that's kind of interesting. So if you kind of shift the way that you think about the IRS code, 10% of it is, you know, how to kind of really tax you, but 90% in a way, if you look at it like this, is how to save money on taxes. And the biggest way is real estate. So that's kind of interesting, but
And
I didn't mean to
I just
take.
want to say one other thing about that. It's funny. So I met my husband, I don't know, a long time ago, like 14 years ago when we were like 6. And so we were in my accountant's office, and he thought I was crazy. He probably still does for different reasons now. But I was like, no, this credit card for this credit card for that. And he's like, you exhaust way too much mental energy. But it wasn't. It was just kind of second nature at that point. But the thing is, we sat down and we compared everything. And at the end, when he finished his returns, he says, you see this, I don't know, $5,200 here? And Bryn says, yeah. He says, if you listened to her, you wouldn't have to pay that. So he suddenly became a believer in,
Right.
I need to understand how to play this game. And they make there's rules out there. Congress sets them, they make them, they play by them. So I've made it as important to my building wealth, or to building income, to being able to keep as much of it as possible and to pass on as much to my kids. And there's so many things we could talk about it. And
Right.
But I encourage you to spend a little bit of your time each month or week or whatever, understanding how to play by the rules. I think it's probably outdated now, but Robert Kiyosaki had, it was one of his co-writers, and I think it was called, I think her name was Diane Kennedy. It might've been, it might not have been, that wrote Loopholes of the Rich. And it was literally just all about the different things based on different business entity structures that you can do to save money on taxes. So I encourage you, and as does Karen, and we'll get back to this particular topic at hand, but you really, because I mean, if you're earning $100,000, and I know there's deductions and all that, but 50,000 of that's going out, you're working twice as hard as you probably have to, or at least, 70% harder than you probably have to. So.
And these are, you guys, we should tell you too, these are legitimate things that, legitimate. I mean, people are, what are you guys doing? It's legitimate. Like, we both have CPAs, we both have bookkeepers. It's legitimate stuff. So let me tell you about this, you guys. This is on taxfoundation.org, and it's, the title of it is Joe Biden's 67% tax on wealth. And Heather, I sent you the link too. And I'm just I'm going to tell you guys what this one paragraph says. So I apologize for reading to you, but I just want you to understand it. And he said, first, he would tax unrealized capital gains at death for taxpayers with incomes above 400,000. So we're talking about people between 400,000 and $1 million. For a deceased taxpayer who earned more than 400,000 but less than $1 million, this would subject those unrealized gains to the current capital gains tax rate of 20%, keeping in mind that's going to go up in 2022, you guys, plus the 3.8% net investment income tax, NIIT, for those of you who see that acronym, for a total of 23.8%. So, and by the way, this is before taxable assets. So we're already looking at that. And Heather, isn't capital gains going to go up to 28% in 2022? Isn't that right?
I don't recall. I mean, that's what it previously was prior to the last tax cut. So I don't know if it automatically reverts back or it has to be voted.
I think it's going, my understanding is going back up, but so 23.8%. But here's what's really interesting is, let's see, they also want to be able to tax the capital gains of millionaires at ordinary income tax rates. So keeping in mind, you guys, many of you be like, oh, well, I don't make that much money and all this other stuff. This will affect everybody. So we're just talking about different levels of income. And many of you, by the time you die, may have that level of income if you don't already, or you already have that in assets because your home, you might have bought it 100,000 10 years ago, but with the way the markets have gone, it's worth $500,000 now. So there's a lot of things that you have to take into consideration here. But let's see, where was I? Okay, so if Biden wants to tax the capital gains of millionaires at ordinary income tax rates, which would be levied at his proposed top marginal rate of 39.6%, add that to the NIT, this would mean a total tax rate on capital gains of 43.4%. If it's 100 million, oh my gosh, this is crazy, taxed at 43.4%, right? The value of the remaining assets in the estate would be 56 million. The estate tax exemption is 3.5%. 5 million. So you have a taxable estate of 53 million. The tax rate is 45% on that one. And taxes owed on the estate would be almost 24 million. So all in and on 100 million, you could be taxed $67 million. Isn't that crazy?
I know some people are probably like, well, I'm not going to have $100 million, so I'm not so worried about it. But
yeah,
how, and that's fine. Many of us won't have $100 million, that's for sure.
Right.
But they use examples like this just to kind of illustrate, just because when we see the big numbers, we can understand it. But if you drop that down, significantly, it still is pretty, it's a pretty big chunk of money that's coming out of your pocket, if you will. And so let's talk about what this means, because you might say, okay, well, whatever, if they have $100 million, but keep in mind, this is stuff that they've worked for, that they've already earned, that they paid taxes on. So this is just kind of a bonus tax, if you will, to the government. And so this is where it's super important to bring in the tax professionals and the tax planners, because some of these things can be eliminated by putting them into trusts, because then that person no longer owns them. But if you were to think of it, and this isn't just necessarily when you sell, this is the tax due when somebody passes away. So let's just say that your family owns a farm. And well, Karen, you had a similar, not similar, but your dad owned a farm. And, let's say it was worth, I'm going to make up, crazy numbers, because we're at different levels here on estate tax. So let's say that farm was worth $10 million. And I think it was 5 million current for the estate tax. So that's $5 million that you have to pay taxes on. It's not when you sell it, you pay the taxes. So that's $5 million. Let's say you're at the 40%, just to simplify, say even 30%, that's $300,000 that you've, right? Was it 5 million? 5 million, did I say? So
5 million
extra. So that'd be $150,000 that you got to write to the IRS. So you've got to sell another asset. You've got to do something to be able to pay that. So to be able to inherit something that your family worked hard for. And a lot of people can't do that. So they're losing, family, farms and things that have been in their families for generations. Now, one of the things, and I don't see if it's explained on here or not, is a change to the stepped up basis. And this is where I think it's important for us to understand as investors, because there's an opportunity, and I hate to say opportunity, but I've made a lot of money in my life with probate and when people pass away, just helping through real estate. So we can talk about probate investing for another day. I've done courses on it. I've done 3-day trainings on it. At first you think, oh my gosh, she's horrible. But then when you look at it from a point of service and how you can help people, it changes the game. So I'm very experienced in working with folks in this situation after the fact. Had they structured things differently, maybe they wouldn't have been forced to sell, or things could have possibly been different. So I say this because there's an opportunity for you. And again, this is not law yet. This is just a proposal, and it's just something to keep in the back of your mind. I just want to clarify that as well. So what happened, and I'll just use my husband as an example. So his dad passed away coming up on 4 years ago, and they got his house in Arkansas. And at the time of his passing, I think it was worth like $425,000. And they have it on the market, I don't even know, 500,000 or 600,000 or something. It's up in Arkansas. It's like 8,000 square feet on an acre on a lake. I'm like, we couldn't get that, in Texas if we wanted to, let alone for 500,000 or 600,000. But nonetheless, under the current system, basically they would be, let's say it's 500 and it was worth 400 at the time of his death. They would essentially get it at that level. So it's the value now. So they inherit that property, let's say at 400,000. If they turn around and sell it for 100,000 on top of that, 5 years down the line, then they would be taxed on that $100,000 gain, because they they took ownership of it at 400,000. Well, under, as I understand this plan, they would actually take ownership at the price his dad bought it. And this is kind of extra not cool, because in a situation like that, if his dad had sold the home and it was his primary residence, as long as he's lived in it for the last two out of the last 5 years, his first 250,000 for single and 500 for married would be tax free. So it's kind of a double-edged sword, because if his dad had sold it, again, under new tax law, before he passed away, or deeded it to him before he passed away, then all that gain would not have been, taxable. He'd have just had it and could pass it on at will. So the difference is now what they're proposing, as I understand it, would be that in that particular case, my husband and his brother would have got the house at he bought the land and built the house at like $50,000. Now, I don't know how that would play into it, but let's just say he bought it for 50,000. Well, now they acquire it and their basis is now 50,000. So when they go to sell it in a couple of years, they're going to be taxed on $450,000 gains. So that's substantial. So when we say, oh, well, I don't have millions of dollars, well, you don't have to. And so when I read that, I thought, well, this is a pretty cool opportunity down the line. It's not tomorrow. It's, and that's what I think makes an investor successful, is when you're thinking 3 to 5 years down the pike, because everybody now is, oh, it's a seller's market. All the, I want to say gurus, because Karen and I have spoken on stages all over the world, really, on real estate investing. And so we know a lot of these folks that are out there personally, and they're not bad people by any means, but the media is saying real estate's on fire. So now these guys and gals are out there saying, hey, here's how you get to invest in real estate. The fact is when it's a buyer's market is the best time to buy real estate, but then it's not sexy because the media's like, oh, the market's going down. Well, that's when you get your deals. So I say that because you need to be looking a couple of years out with your strategy at all times. Yeah. So when I started looking at this, I thought, there's a really cool way to serve people and to make things, make it a win-win as an investor, and also for, older people that want to leave something to their heirs. And so you can easily go out and find people that have owned their home for X number of years, depending on your market, but you go find people that have owned their properties for 20 years, have your accountant write an article on this particular topic and how it affects people. And if you did it in your area, they could kind of use numbers that make sense in your area. Then you send out a letter to everybody that's owned their home for, let's say, 20 years and say, hey, just in case and you could do a co-op marketing plan with your accountant or estate planning person or what have you. It could be a really cool way to get them some business and also help a lot of people. So you say, hey, I can purchase your home now. I'll rent it back to you for basically whatever your mortgage payment is. You got to do numbers. We're not talking numbers. We're talking strategy right now.
Right.
And then so you can cash out on the house. You can put it in your bank. You can put it in a trust. You can pass it on now. You can do whatever it is that you want to do with this money. But your heirs aren't going to have to deal with whatever the aftermath is if this is your goal. And you'd want to word it very, very tenderly. So you're not, because you're not trying to prey on people. You're truly helping them keep their heirs from having to pay, let's say they thought they were giving their heirs $500,000 in assets. Instead, it's really 300. Sure, it's better than a kick in the pants, but why not let them keep that?
Right.
So I think, what piqued my interest on the topic and why I wanted to understand it was not to get into a political debate, but rather to say, okay, if this comes down the pike, what do we do? How do we play within the rules, and how can we stand out and be helpful? So
that's kind of what we always say, Heather. And I mean, this is a huge example, of course. I don't have 100 million. You don't have 100 million.
Right.
They're just doing that, for shock factor. But it's still like the math is easy to look at. But the Pete and I always say that, like it, as far as the president or the administration goes, yes, it matters. I don't want to say it doesn't matter. It does matter. But the reality is you just have to understand it and then set your things up accordingly. So, Pete always says, just learn the game and learn to play the game. And I think that's exactly what we're saying here today. So, it might be that you want to be a little bit more proactive with your estate. And if we didn't get anything else across, maybe just the idea of you saying, you know, let me just discuss it with my attorney and my CPA, just so I know, just so I'm informed, and I can set things up in the best possible way for myself and my family. And I mean, that's really what this is all about, right? I mean, that's what it's about for me. It's what it's about for you. And, you know, and that's what we're looking at. So just be aware of it and set it up accordingly. There's so many legitimate ways to help, you know, help you save money or help you save money for your heirs.
Exactly.
Mhm.
So I guess if we were to leave you with a couple of points from today, one is to really get educated on taxes and the tax laws.
Mhm.
And
Yeah.
I don't even want to say loopholes. And here's one thing to kind of squelch anybody's terror, you know, who's terrified about taxes, you know, potentially going up or whatever. Just know that Congress has to play by most of the same rules. They obviously are exempt from certain rules that they choose, but they still have to follow the tax rules. And so if you can, as far as we know, right?
Right.
If you can learn the rules that they've created, I promise you there's going to be I'll say loopholes because we're familiar with that term. There's going to be ways out there to save money and keep more of it. So when you see like this 67% tax number, make no mistake, none of those people in Congress, none of the, you know, wealthy entrepreneurs that are paying attention to this stuff are paying anywhere close to that. So make it a part of your education, like the tax planning and the tax saving, because I think it's equally as important as anything you're doing to generate the income, because why work twice as hard as you have to get to the same place?
And I think, yeah, talk to your CPA, find out what tax bracket you're in. And, you know, if you're going to leave things to your family, like what is the tax? What is going to be the tax rate for you in order to do that? And is there a smarter way to do it?
Mm-hmm. Absolutely.
So,
So,
all right.
well, I
I
know
love
this
this
is a little
talk.
more
I
technical.
love this crazy tax talk.
I know you hear Karen and I get
I know.
excited, and most people eyes glaze over and they're like, what? And then there's Karen's husband who's reading, you know, the ins and outs of the tax code, and let me know when he's done with 7,326. If he's still enjoying it.
Yeah.
So
Whenever he talks taxes, I'm like, you are so hot and sexy to me right now. That's what I always tell him when he's like, did you know this about tax? I'm like, oh, you are so hot and sexy right now.
isn't he from England? Like this whole taxation without representation still must be getting to him, I guess.
Right. Yeah.
Years ago.
It's exactly true.
So, well, awesome. I hope you guys got, you know, at least, again, we're not accountants and all that good stuff, but I hope that you guys have at least sort of open your eyes, if you will, to paying attention to taxes a little bit more and seeing how you can save money. And then forward looking, if the rules change, how do I need to change with the rules? Because we can't do anything about them. So we have to learn how to live within them and play by them. So again, I'm Heather Tankersley. I am here in Austin, Texas, and do quite a bit of investing in Southeast Florida as well. Would love to help you with your investment properties. If you have deals that you're looking to wholesale out, I'd certainly love to take a look at those. As Karen said, we'd be happy to evaluate deals with you from anywhere in the country. And if you're looking to sell a home or move to Austin, I'd certainly love to kind of meet with you and sort of see if we'd be a good fit to work together personally on your traditional stuff as well. And Karen?
Yep, Karen Schaefer, all the same here in Colorado. Thanks for joining us, you guys.
Awesome. Y'all have a great rest of your week. And I guess we'll probably take next week off because it's the day before Thanksgiving. So just want to wish everybody a happy Thanksgiving, happy, healthy, and safe Thanksgiving. So have a great 2 weeks, guys. Take care.
Bye. See ya.
Bye-bye.